Loan consolidation and refinancing offer different approaches to managing student debt, each with its own set of advantages and drawbacks. Loan consolidation combines multiple federal loans into one, simplifying repayment with a single monthly bill. The interest rate is fixed and based on the weighted average of the original loans. While consolidation doesn't lower interest rates, it can extend repayment terms, which may lower monthly payments but could increase overall interest costs. It also allows borrowers to retain access to federal loan benefits, such as income-driven repayment and loan forgiveness. Refinancing, on the other hand, involves replacing one or more loans, federal or private, with a new loan from a private lender. Refinancing can reduce interest rates and monthly payments, but it requires good credit and a steady income. Unlike consolidation, refinancing forfeits federal protections, so it's essential to consider whether losing options like deferment, forbearance, or income-driven plans is worth the potential savings. By understanding these two options, borrowers can choose a path that aligns with their financial goals and stability.
Parts. Mark, can you walk us through the decision-making process for borrowers considering consolidation versus refinancing, and when one option may be better than another?
Well, generally speaking, the longer the repayment term, the lower the monthly payment, but the more interest you will pay over the life of the loan. And if you can choose a shorter repayment term, you'll pay less total interest and you'll pay it off much sooner. I mean, if you get a 20 or 25-year repayment plan, you may still be repaying your own student loans when your children go to college. So you should choose, if you're not going for forgiveness, you should choose the repayment plan with the highest monthly payment you can afford so that you pay the least interest and you pay it off the soonest. But if you're pursuing public service loan forgiveness, where the remaining debt will be forgiven, then you want the lowest monthly payment. And so with the public service loan forgiveness, you couple it with an income-driven repayment plan, which bases your monthly payment on a percentage of your discretionary income as opposed to the amount you owe. So if you're in a low-paying field, like public school teacher, that doesn't pay very well, and therefore your ability to repay the debt is more limited, the income-driven repayment plan yields a more affordable monthly payment. And public service loan forgiveness means that the remaining debt is forgiven after 10 years under 20 payments.
Rae, how do you advise clients who are unsure whether they should consolidate or refinance their loans?
Well, that's really on a case-by-case basis. So there are some limited circumstances where it makes sense to refinance your federal loan and turn it into a private loan. For example, if you are a high income earner and you can get your federal loan refinanced for a much, much lower interest rate, and you know that you are never going to be going for a public service loan forgiveness, in certain cases, it does make sense to turn your federal loan into a private loan. But those are pretty rare instances. And, I think the one thing that borrowers need to know is that federal loans have a great many number of options in terms of payment plans, forgiveness options that may apply to you, and you never know where your life is going to take you. So it's nice to have those federal provisions under the Higher Education Act where, let's say, God forbid, you lose your job and you weren't expecting that or counting on that, and you are a high income earner. Well, now you're in a position where you can enter into an income-driven repayment plan for a very, very low monthly payment that can be recalculated based on your change of circumstances, because now you have much lower income. Let's say you've lost your job or you have an illness. You may even be able to have your loans, if you're not able to resume employment, forgiven in one fell swoop. So there are only really those kinds of protections and provisions available with federal student loans. And it's nice to have those in case you need them. So it's a rare instance where I would advise somebody to take their federal loan and refinance it into a private loan, because you lose all of those options that you may need in the future, depending on what life brings you. So I would be very careful about that, because once you turn them into a private loan, there's no going back. You can't then reverse that and turn it back into a federal loan.
Sonia, what are your thoughts?
It's a very tricky topic because I remember when we were working with clients right when the pandemic hit, and everyone that had federal loans, direct loans, were able to be put into a protective provision because of the pandemic. But you had people that had just refinanced their federal loans because they had good credit, or they were high income earners, and then they lost the protection and the provision of federal loans. And my advice in this season, especially with everything happening with the Biden administration regarding loan forgiveness, and we don't know what's going to happen due to election, it probably would not be in the best interest right now to refinance a loan, because depending on the time in which someone has had that loan, depending on the other programs they could be eligible for, when we look at what the Biden administration, which would be now the Harris administration, would be proposing to do some forgiveness under, a lot of people fall under that forgiveness, but they would be opting out by refinancing. So are we advocates of refinancing here? No, because right now it's just so much in terms of change that it would be just so sad to say, yeah, I think that'd be a great idea. And then they lose out on all of these federal benefits. And if anything we learned with the pandemic, we just don't know if there's another pandemic, or we don't know with what's happening. Just even right now, our hearts are going out to those that are in Florida with weather related things that are happening. You take yourself out of the safety and provision of what you could be eligible for when you refinance a federal loan into a private loan. Now, private on private for a better rate, that's different. But no, it's just not my first recommendation or choice to give someone, just because we've seen what has happened to those that did that, and there was no relief for them.
Mm. Kate, how do consolidation and refinancing decisions differ across socioeconomic classes? And maybe what broader lessons can we take from those trends?
Well, the major trend or the major issue that I see here is that we treat education in a very similar way to how we treat another what is usually thought of as a private good, which is buying a home, right? So when we're talking about refinancing or consolidating, that this is actually an effect of how we've designed the federal loan financing system for higher education, and that is actually a really awkward fit. It's a bit of a mismatch between the requirements of education, what we want education to do, the kinds of careers that we want people to be entering into and preparing for, like teaching, which is one of the most popular professions in the United States, and what we ask them to do in terms of their loans. So I think that there is a really a systemic design problem that we all face, and that the Biden administration is trying to take on, has been trying to take on, but there is a very long way to go.
Mark, any follow-up?
Oh, I wanted to follow up to something that was said before about Parent Plus loans, which is students at HBCUs are much more likely to have parents borrowing the Parent Plus loan than students at other colleges. And oftentimes it's not the parent who's repaying the loan, but the student. So these students are graduating not just with their own student loans, but also with the Parent Plus loans. And if they obtain public service loan forgiveness, that's only going to forgive their own student loans and not the Parent Plus loans. So the burden on students at HBCUs, which have been historically underfunded, is that much greater than students at other colleges and universities.
Is there a better alternative that they can seek?
Well, unfortunately, federal grants have not kept pace with increases in college costs, and private scholarships, there are about $7 billion of private scholarships. So, I mean, you have maybe 14 or 15% of students in bachelor degree programs receiving private scholarships. with an average amount of about $2,500. I mean, well, average amount among those who receive it is just under 5,000. So this idea that you can get a completely free ride through scholarships is pretty rare. I mean, I did it when I was a kid, but I mean, most people, we're not talking about a free ride. So the things that you can do is you can save before college. I started saving before my kids were born. And you can try to pay off the student loans quicker and to keep the amount that you borrow to a minimum. You can also choose a less expensive college. Often your least expensive college is going to be an in-state public college. Even though they don't give out as much financial aid, the net price at those colleges is often a quarter to a third that of a higher cost private college. Though there are about 6 dozen mostly private colleges with these no loans financial aid policies where they replace loans with grants in the financial aid package. So shop around is a key bit of advice, and both not just for the least expensive loans or the loans that have the options you need, but also for the college that is going to be more affordable. You may want to buy a Lexus, but all I can afford is a Yaris, and that's a much less expensive option, even without financial aid.
Well, I'm hoping that we can all learn the ropes and learn how to shop around, and that it doesn't require a degree at MIT for us to decode all of this. Let's move on to segment 3.